Welcome back to the deep dive. Today, we are looking at a topic that, on the surface, sounds like, well, a cure for insomnia: uranium mining schedules in Central Asia. Specifically, Kazatomprom, or KAP.
It sounds dry.
It sounds incredibly dry. I mean, it sounds like a spreadsheet error. But once you actually get into this stack of research, and we have a lot of it today, you realize it's not really about rocks or mining schedules at all.
No.
It's a psychological thriller. It's about trust, fear, and what happens when an entire global supply chain realizes it's been living in a fantasy world for about 20 years.
That is the perfect way to frame it. I mean, we are literally looking at a market waiting up from a very long, very comfortable dream.
So the mission for this deep dive is to sort of dismantle a headline that everyone's seeing. The standard take right now is pretty simple.
Correct.
KAP is the world's biggest producer. They're producing less uranium, so supply is down, prices go up. Economics 101.
And that's true, but it's so superficial. If you stop there, you miss the actual signal.
What's the signal?
The research we're unpacking today argues that we aren't just seeing a price cycle. We are seeing a structural transformation. We're moving from a volume story, how many pounds are in the ground.
To a reliability story.
Exactly. And that shift hinges on a concept that completely blew my mind when I first read it: the invisible subsidy.
Yes. This is the core insight, isn't it?
It is.
Okay, so break that down for us, because usually when we hear subsidy, we think government checks or tax breaks.
Yeah.
But this is something else.
Think about the last 2 decades. Uranium prices were incredibly low. Why? Well, on the surface, because there was plenty of it. But the research argues the prices were low because of an invisible subsidy of certainty. Every utility buyer, the folks running reactors in France, the US, Japan, they all operated on this unspoken assumption that if they ever got into a jam, the supply would just be there.
They didn't have to pay for security because they assumed security was free.
Exactly. They priced in a guarantee that didn't actually exist on paper. They assumed the market had this infinite backstop.
And what's happening with KEP now isn't just about them removing pounds from the market.
No, they're removing the guarantee. They're stripping away the certainty.
So we aren't just looking at a supply shortage. We're looking at a reliability crisis.
Which is so much harder to price. When you lose reliability, the reaction is not linear. It's not a gentle slope where prices creep up. It's a cliff.
Okay, let's get into the mechanics of that cliff. The research talks about this mindset that ruled the market, something called inventory optimism.
Inventory optimism. It sounds like a corporate buzzword, but it was really a survival strategy for utilities.
A strategy of I'll figure it out later.
Essentially. For 20 years, the mindset was, I don't need to hoard fuel. Somewhere, somehow, there will be spare pounds if I need them. But that optimism wasn't magic. It rested on 3 very specific pillars.
And to understand the panic now, we have to understand those pillars.
You have to.
Okay, let's knock them down. Pillar 1.
Pillar 1 was KAP acting as the global swing producer. I mean, KAP is massive. They have the biggest, lowest cost mines in the world. So the assumption was that they were the central bank of uranium.
Like Saudi Arabia with oil. They were the release valve.
That's it, exactly. If the world needed more, KAP would just turn a dial and flood the market. That's 1. Pillar 2 was secondary supply acting as a shock absorber.
What's that?
This is material held by traders, hedge funds, excess government stockpiles. The belief was that this mobile inventory would always just slide in to fill any gaps. It was liquid.
Okay, and the third pillar.
This is the technical one. And honestly, the most dangerous assumption of them all. The belief that ISR, mining in situ recovery, is infinitely flexible.
That you can just pause a mine, walk away, come back 2 years later, and restart it with 0 penalty. Okay, hold on. We need to pause there because I want to challenge that. Why would anyone think mining is infinitely flexible?
Yeah.
I mean, even in a factory, if you shut down the machines, it takes time to restart. Why did the smartest people in the energy sector think they could toggle a mine on and off like a light switch?
Well, because of the geology and the method. See, ISR isn't like digging a tunnel. You're not sending miners down with pickaxes.
Right.
You're pumping fluid into sandstone. It feels like plumbing, and plumbing feels controllable, right?
Sure.
If you turn off your kitchen faucet, the water is still there an hour later. So the industry just lulled itself into believing the ground was basically a storage tank.
But the research we're looking at says that's a massive fallacy.
A huge fallacy. And this is where the current situation with KAP gets so scary. Their production struggles don't just chip away at one of those pillars.
They demolish all 3 at the same time.
Simultaneously.
How does that happen?
Yeah.
I mean, I get pillar 1. If they're cutting guidance, they're obviously not the swing producer anymore.
Right. That's the obvious one. But look at the knock-on effects. Because KAP is producing less than their contracts require, they have to go into the market and buy uranium just to fulfill their deals.
So the biggest producer in the world becomes a consumer.
Correct. They are soaking up that secondary supply to cover their own shorts. So there goes Pillar 2. The buffer is being eaten by the guy who was supposed to be the supplier.
Wow. And Pillar 3.
The reason they're short in the first place is largely due to technical issues. Shortages of sulfuric acid, delays bringing well fields online, which proves publicly and undeniably that ISR mining is not infinitely flexible.
You can't just snap your fingers and catch up.
You can't. So it's a multiplicative failure.
Yeah.
It's not 1 + 1 + 1. It's the entire safety net vanishing at once.
And this brings us to a really critical distinction in the notes. Inventory versus deliverability.
This was a huge aha moment for me, too.
Because if you just look at a geological map, there's plenty of uranium on Earth. We are not running out of atoms.
No, we are swimming in atoms. Geologically, we're fine. There's plenty of inventory on paper.
But the source says availability does not equal deliverability.
And that is the bumper sticker for this entire deep dive. A utility buyer in Chicago or Tokyo cannot burn geology. They can't burn a promise or a resource estimate. They need fabricated fuel rods delivered to their reactor on a specific Tuesday.
Right.
When KP struggles, the question shifts. Utilities stop asking, how much uranium exists? And they start asking, who can I actually trust to get it to me?
And that shift, that's fear.
That's pure fear. It
Okay.
changes the commodity from just a raw material into a service, the service of reliability.
I want to double click on the technical side of this. We kind of glossed over the ISR thing, but the research calls it the trap of deferred ISR. Why is this so specific to uranium? If I'm mining gold or copper and I stop for a year, the gold's still there, right?
In hard rock mining, yes. If you're digging a pit for copper and you stop because prices are low, the rock doesn't change. The geometry is stable. Your equipment might rest, but the ore body is passive. It just waits for you. It's inert.
But KAP uses in-situ recovery. So for the layperson, what is actually happening underground that makes it so risky to stop?
Okay, imagine a giant solid sponge made of sandstone, deep underground. The uranium is trapped in the tiny pores of that sponge.
Okay.
To get it out, you drill wells and inject a solution, usually an acid. That fluid flows through the sponge, it dissolves the uranium, and then you pump the uranium-rich water back up and filter it out.
So it's active chemistry. You're running a chemical reaction 500 feet underground.
Precisely. Now imagine you stop that process halfway through, or you delay developing a new section. You aren't just leaving rocks alone, you're altering the chemical balance of the aquifer. The research details this specifically. The flow paths can shift.
What does that mean, flow paths shift?
It means the liquid takes the path of least resistance. If you stop pumping, sediments can settle. Precipitates like gypsum can build up and just clog the tiny pores in the sandstone.
Like cholesterol in an artery.
That is a great analogy, exactly like that. So when you turn the pumps back on 2 years later, the fluid doesn't flow where it used to. It bypasses the uranium. Your sweep efficiency just drops through the floor.
So you're pumping the same amount of acid, maybe more, but you're getting less uranium back.
Yes. You see what they call acid intensity rise, which is a polite way of saying your costs explode because you're just dumping more and more chemicals down the hole for less product. The chemistry is fighting back.
And the market has been treating these deferred pounds, this uranium that KAP said they'd get to later, as if it were cash in a vault.
And the research argues they're not cash, they're call options.
All options explain that.
Yeah. A call option gives you the right to buy something, but it doesn't guarantee the asset is easy to get. These deferred pounds are call options with a very high operational risk. You might get them, but it's going to cost more, it's going to take longer, and it will be far less predictable than you planned.
That is a terrifying distinction for a buyer. I mean, if I'm a utility, I want boring. I want baseload contracts. I don't want a high-risk call option.
You want certainty. And this creates a massive mismatch. The market spreadsheets, the ones analysts use in London and New York, they say KAP has X million pounds in the ground.
Right.
But the reality is X minus technical degradation, and that gap, that invisible gap between the spreadsheet and the geology, that is where the price explosion is hiding.
Which leads us directly to the people who have to deal with this mess. The buyers. The utilities.
The people whose job it is to keep the lights on.
The source describes their behavior as asymmetric. And it talks about a reflexive loop. Can we unpack the psychology of the fuel buyer? Because I feel like we assume these are just algorithms buying commodities, but they're people. They have careers on the line.
They are very, very stressed people. Let's put ourselves in their shoes. You are the fuel buyer for a major utility. You face two basic risks. Risk A, you buy too much uranium, you panic and overcontract.
Okay, so I spent too much of the company's money. I've got a warehouse full of drums I don't need yet.
Right. What happens to you? Probably nothing. Maybe your CFO is annoyed. Maybe it's a drag on working capital for a few quarters. It is, at worst, an accounting inconvenience.
I'll keep my job.
You definitely keep your job. You might even get a bonus if prices go up later and you look smart. Now, look at risk B. You play it cool. You trust the market. But then a delivery fails. You have a shortage.
Oh, no.
And the reactor, which costs billions of dollars and powers a city, has to shut down because you don't have fuel.
That sounds bad.
It's catastrophic. It's a grid stability issue. People lose power. Hospitals lose power. The regulatory blowback is immense. And for you personally, you are fired. Immediately. Probably blacklisted from the entire industry.
So the penalty for having too little is infinitely higher than the penalty for having too much.
Exactly. That is the asymmetry. For 20 years, that invisible subsidy of certainty allowed them to basically ignore risk B. They knew KAP would be there. They knew the market was liquid.
And now that certainty is gone.
It's gone. So what is the only rational move for a buyer who wants to stay employed?
Buy everything.
Buy everything. Overcontract. Strip every last bit of optionality out of the system. If you need 100 pounds, you buy 120, just in case. And you do it now, not later.
They're essentially saying, I don't care about the price anymore, I care about security.
Correct. And here's the real kicker, the point the source makes that is so chilling. This behavior is irreversible.
Explain that. If the price spikes and then supply stabilizes, don't they just go back to normal?
No, because you can't unring the bell on reliability. Once you have looked into the abyss of a fuel shortage, you don't go back to living on the edge. The just-in-time delivery model, that efficiency model of the last 2 decades, is dead. It has been dismantled by fear.
It reminds me of what happened with supply chains during COVID. Companies went from lean inventory to just get me the stuff, I don't care what it costs.
It is the exact same dynamic. We are moving from just in time to just in case. And just in case requires a lot more inventory, which means much higher sustained demand. It permanently resets the market's clearing conditions.
So this isn't just a spike that goes up and comes down. We're actually resetting the baseline.
We are stepping up a rung on the ladder, and we're not stepping down. The floor price has moved.
This creates a whole new reality for the market structure itself. The source talks about market bifurcation, the splitting of the market. What does that look like?
It means we're going to see 2 distinct worlds of uranium emerge, a Tier 1 and a Tier 2.
Define them.
Tier 1 is the premium market. This is long-term contracts with producers in politically safe jurisdictions who have proven they can deliver. You know, think Canada, Australia, maybe parts of the U.S.
The sleep well at night pounds.
Exactly. Utilities will pay a massive premium for these. High prices, strict terms, 10-year commitments with floors and ceilings. They will lock this stuff up because this is the fuel that guarantees the reactor runs.
And Tier 2.
That's everything else. The spot market. Material from shaky jurisdictions, traders flipping pounds. This market will be volatile, thin, and fundamentally unreliable.
But here's the confusing part for a lot of people. Usually when we watch the news, we look at the spot price to tell us what uranium is worth.
And the research argues that is now a broken signal. In a bifurcated market, the spot price loses its power. The real action happens in the term price, in those private long-term contracts.
So we could see a situation where the Scott price on the ticker is bouncing around at, say, $80 or $90, but the real price, the price to actually get fuel delivered in 2028, is quietly climbing to 120, 130.
That's exactly it. The spot market becomes a distraction. It's the noise, not the signal.
That seems like a massive trap for investors who are just watching the daily charts.
It is, because the structural repricing is happening in the boardrooms, not on the trading screen. And this changes the financing for the whole industry.
How so?
Well, think about it. If the just-in-time model is dead, utilities have to carry more inventory. That ties up hundreds of millions of dollars in capital. And capital isn't free anymore. Interest rates are real.
And if we need new mines to replace the unreliable ones,
financiers are going to demand much higher prices to fund those projects. They know the risk now. They aren't going to fund a new mine based on $60 uranium if the risk of failure is this high. They need $90 or $100 to justify the capital risk.
So the entire floor of the market just rises.
And the leverage flips. For 20 years, producers were begging utilities to buy. Please, take my uranium. Now, the utilities are knocking on the producers' doors, begging for slots. The producers who can deliver, the reliable ones, have permanent negotiating leverage.
It really is a total inversion of the market.
It is. And it's all happening because we mistook certainty for abundance. We thought we had a lot of uranium, but what we actually had was a lot of trust in a system that is now breaking.
So let's bring this all home. We started this deep dive thinking about headlines, KP producing less uranium.
And we realized that is just the tiny tip of a very large iceberg.
We've gone from a story about missing pounds to a story about missing certainty.
That's the summary in a nutshell. KP isn't just producing less uranium, they are producing less predictability. And in a nuclear market where failure is not an option, predictability is the most expensive commodity on Earth.
And when that certainty disappears, prices don't just go up a little to compensate, they overshoot.
They overshoot because you can't model panic in an Excel sheet. You can't put a number on I don't want to get fired. That human element is what drives the overshoot.
It's fascinating to think that a chemical change in a well field in Kazakhstan can directly change the career risk of a buyer in Pennsylvania.
Everything is connected, and the connection is reliability.
Before we sign off, I want to leave the listener with one final thought from the source material. It's a bit of a brain teaser about the financial side of this.
You mean the financial vehicles, the trusts?
Right. In the last few years, we've seen these massive funds, like the Sprott Physical Uranium Trust, that buy physical uranium and just lock it away. Yeah. Investors love them because they take pounds off the market. But the source poses a provocative question.
Yeah.
Do these vehicles act as a relief valve? Or do they actually make this reliability crisis worse?
It's the billion-dollar question, isn't it? If the market is splitting into Tier 1 and Tier 2, and these financial vehicles are just sitting there vacuuming up all the Tier 2 spot material.
They're removing the last buffer.
Exactly. They might be tightening the screws even harder. If a utility gets desperate and goes to the spot market for an emergency fill, they might find that a financial trust has already cleaned it out.
So these funds act like a ratchet. They allow the price to go up, but they prevent that inventory from ever flowing back to the utilities who actually need it to keep the lights on.
It creates an asymmetric upside. Even if demand doesn't surprise us, the very architecture of the market has changed to trap material away from the end consumer. It's a structural squeeze.
A structural transformation, not just another price cycle.
Couldn't have said it better myself.
That is all for this deep dive. As always, thanks for listening, and we'll catch you on the next one.
Stay curious.